Hello.
Respected Speaker, Mr. Sandeep Dasgupta, members of faculty, and my dear friends. I welcome you all to this morning session of Rabindra Talks. Today, we are proud to have amongst us Mr. Sandeep Dasgupta, who is a distinguished speaker, and also he has a vast experience in the field of finance, especially in asset management. Mr. Sandeep Dasgupta is an electronics engineer and MBA from IIM Ahmedabad, 1985-87 batch. He has around 20 years of work experience in the financial services industry. Between 1985-95, he worked in the area of investment banking in organizations like ICICI, Hong Kong Bank, and ITC Financial Services. He moved to asset management in 1995 while working with ITC Group and was assigned the role of All India Sales and Distribution in ITC Threadneedle Asset Management. In 1996, Mr. Sandeep moved to Alliance Capital Asset Management as country head of sales and marketing. In February 2001, Mr. Sandeep joined the Deutsche Group to launch and head the asset management in India as the CEO. Deutsche Asset Management India commenced operations in January 2003. Currently, Mr. Dasgupta is also a director in the board of the India Asset Management Company and member of Deutsche Bank India Executive Committee. One more proud piece of information for us. He has written a paper along with Professor Shama Fernandez on indexation industry in India.
Correction. I have written the paper along with him. He was the main author.
Correction, sir.
So you get all the products, right?
It is also available for all of us. I now welcome Mr. Sandeep.
I don't know what you guys are expecting from this series. I'm a market participant, so I'm not a distinguished professional like Mr. Das and Raj and others and Shama. Very frankly, I did work with Mr. Das and I asked him as to what you were expecting out of this 1.5 hour, in case you allow me to spend so much time. My personal view would be that if there are more interactions, that would be ideal. I'm sure there are very bright boys and girls out here. I'm sure they have a lot of questions on any facets of financial services industry. That's where I have spent my last 20 years. I would encourage all of you to question. Please raise your hand, and I think that would be much more fruitful and meaningful as opposed to me just going on and on. I can go on and on based on the experience that I've got, but that is not the purpose. The purpose is to interact, and that way I would know actually what is it that you want to know. Apart from that, of course, I would like to leave this room after some time with some thoughts, share with you my experiences in the industry. I was having a brief chat with Prashant in the morning when I came from the airport. I'm telling him that 20 years back, I was also in the same stage as you are in, and same aspirations, same ambitions and desires. Some not right, some not right. So it might be useful for me to share with you as to what really counts finally at the end of the day. I'm sure all of you are reading subjects like HRD and organization behavior. Must be getting bored at times. We used to get bored. It's more meaningless just do finance and high-tech stuff. Right? But it's natural because most of you, I'm sure, in this room do not have too much of work experience. Maybe some of you have got. How many of you have work experience? Oh, that's great. How many years, roughly? 2 years. 2 years, 2 to 3 years. So you have some experience, which is good. I mean, those days, in my batch, for instance, there weren't too many people with work experience. People who had about 8 to 10 years experience, and they used to always tell us, look, this is not important, this is important. And that's true in life. So I'd like to share some of my experiences, and that's very standard, nothing to do with the asset management or financial services. And feel free to question me. So Prashant, if I may ask you, how do you think we should go ahead? Should I just
you can share the experiences first and then you can analyze.
Okay. First of all, since we are focusing on financial service industry, I told Mr. Das that you've had speakers from the industry, both from manufacturing and advertising, but maybe didn't have the opportunity to talk to the financial services industry. What's your name? David. He introduced me. I did spend the first 10 years in investment banking. It used to be called merchant banking those days. Investment banking emerged lately as the foreign investment bankers stepped in, government allowed these guys to take stake. It used to be called merchant banking, plain vanilla corporate finance, raising money from the capital market, IPOs, etc. Today the word investment banking has enlarged itself. It's got into many more activities because of cross-border transactions and a lot more structured deals happening. And the last 10 years have been asset management. 1987 when I joined, that was pre-1991 days. And the reason I'm always repeating pre-1991 is that 1991, as you probably are aware, was a significant development for the industry as a whole. In fact, last week I was fortunate to be sitting in the ET Economic Times Corporate Excellence Award ceremony, and we have this 5 gentlemen right in front of us: Mr. Manmohan Singh, Prime Minister, Finance Minister, Chidambaram, Mr. Ramarajan, Mr. Reddy, who is the present governor, and Monty Singh. And interestingly, it was a celebration of 15 years of India's economic reform, and all the 5 gentlemen out there were finance people. So I'm not suggesting that finance is the most important factor for this country having opened up, but it does play a very, very important role, extremely important role. And if you read some of the older books, and they will say that the main street is driven by Wall Street, or Dalal Street as we call it in India. Till 1970s, as we have very experienced bankers here, they will vouch for it. It was a very closed economy, and from 689 banks in 1947, it came down to 80 or 69 odd banks, as a lot of banks just couldn't cope up, and there were a lot of mergers and consolidation. Then we got into the era of nationalization. And from, I think between 69 to 80, if you ask me very frankly, I think we did nothing in this country. We could have done much better. We could have been in China today, but for the fact that it was an absolutely closed economy. And between 1980 to 1991 is when actually government started looking into these aspects. And thanks to the fact that we came into a crisis in the year 1990-91 when we had mortgage gold, as you are aware, I think the country was forced to open up. The reason I'm repeating this history a little bit is that you should know as to what we read about finance today, or various jargons and financial services. It actually is only maybe 7 to 8 years old, at least in this country. It all happened because of 1991. If that had got delayed by another 10 years, unfortunately all of you in this room would be just talking about a pure plain vanilla retail banking job, or a merchant banking job. It would have opened up to such large gamut of activities that we see today. And that's why I'm coming to it now, that I don't know how much exposure you guys have got, but let me tell you that whatever we see today and what we're going to see 5 years from now, I think all of you in this room can expect huge opportunities, especially in the financial services industry. Not because I'm from the industry, because this industry picks up talent, picks up very, very good talent. This is an industry which is at the forefront of any economic upswing, and we are seeing the upswing. And when we talk about financial sector, first thing comes to our mind is banking. Obviously, everything emanates out of banking. So if you look at SBI today, which is a traditional banker, and I remember, just to give you an anecdote, a couple of years back when I went to my small town to meet my grandmother, and I told him I work with a bank. He said, which bank? I said, Deutsche Bank. Obviously, she couldn't pronounce that name. He says, what this bank is all about? I said, it's a German bank. So she said, you must be doing very well in your job, because they must have put you in the teller machine to count checks in a German bank, and I'm told they're a very good bank. So that's the definition of a banker, from a traditional point of view. And I went and met somebody, my uncle in Calcutta, and I was venturing into the word asset management. I said, I don't work in a bank because I had a bad experience with my grandmother. I said, I work with an asset management company, and they said, asset management, so you manage assets. You must be, having high security with lots of vaults and all the cash is kept there. So that's the definition of asset management for most of the people, I guess. So nothing unnatural because everything has happened in the last 5-6 years. Most of this new stuff, what you see, is happening in the last 5 to 7 years. So the awareness about non-traditional banking is very limited. If you go to a place like Bombay, obviously people are much more aware. But if you just go beyond Bombay, even to smaller towns like Pune or Kolhapur, they would have very little knowledge. But the interesting part is that the mutual fund which I work with clearly touches the heart of the retail investor, and that is why I think the awareness is much higher. When you guys think of joining a bank like Deutsche Bank or Bank of America or Citibank, you have to obviously understand that it is much beyond consumer banking and retail banking. All these banks have now a large number of businesses. Each one is a separate silo. And I was telling a professor just now that most of the banks, global banks like ours, have complete silos because each product is a specialized product, and you can't run the banks these days with a traditional structure of a chief country officer running each businesses. Each business is so specialized that you need technology and expertise from overseas groups. That's how you operate. So coming back to financial services, as I mentioned, what we have seen in the last, say, 6-7 years is obviously first the emergence of the global players coming to the country because the country opened up. What they did is obviously bring in technology, bring in expertise, bring in cross-border transactions. That was the first step which happened. We saw the emergence of FIIs, and if you look at the capital market area, FIIs today play a big role. If you don't understand anything, please ask me a question. Feel free to ask me to pause. From a traditional banking and financial institution background that this country was exposed to, where people had to go to ICICI or IDBI to actually, where I used to work in ICICI in 1987, the only way you could finance your project was either to go to a bank for working capital or go to a financial institution like ICICI, IDBI or IFCI for a long-term project finance. And that's how the traditionally very high interest rate regime that we had, 14%, 16%, people had to borrow money on those rates. And quite clearly, because it was a protected economy, the bigger guys survived and the smaller guys just couldn't survive, and we had huge default ratio. Because when you borrow at 16%, there's no way you can manage each business with that kind of IRR. And that's how the capital market, when it actually started growing from the last 10 to 15 years, with the emergence of many more players. As you recollect, we used to have UTI, Unit Trust of India, as probably the single most important asset management company in this country, which is to participate in capital market. And you have the three financial institutions, IDBI, IFCI, and ICICI, and we have to have post of that. That's about it. And that's the only source of finance people had for long-term project financing. And it was very restricted, very high cost, and that led to high default ratio, a lot of credit failures. And when the capital market really started growing, that really changed the complex and the landscape of this industry, of this country, if you ask me. When they initially allowed FIIs to come in, they allowed mutual funds to be set up, they allowed private equity firms to actually set up, they allowed venture capital. So suddenly, the industries actually had large number of resources to choose from. And the smarter players, like if you look at Infosys today, they have never borrowed, right? Except for SBI having, I'm sure Mr. Rajan knows, were the main bankers who used to provide some working capital finance. Infosys, till this day, have never borrowed money from financial institutions for long-term financing. They actually resorted to capital market. And I was fortunate enough to be working with this firm for Enhanced Financial those days. And when Infosys came to us for the first publication, I don't know whether some of you are aware of it, in the year 1992, with a 90+10 publication, when we said you are crazy. So you're not known, you're a small company, at 100 rupees per 10 rupee share, nobody's going to buy. Okay? They said, no, we have to launch it at 100 rupees. We are very, very clear. Mr. Naranmurthy, Mr. Nandan Nilanthani, we all sat and we said, okay, let's go ahead. And unfortunately for them, as you know, in the year March 1992, there was a bomb blast. And 10th of March is when the public issue was about to close. And that's the day when the bomb blast happened. And the issue got unsubscribed. I don't know whether you're aware of this history. The issue was not subscribed. And we had to actually literally beg and persuade people to invest in that stock. And then you know the history, right? So Infosys or Wipros or TCS of the world would have emerged today in this country, but for capital market. If they had to resort to high capital, high interest bearing capital, it would have been very difficult. So the capital market is what I'm actually focusing on, actually developed after the country being opened up, and we had FIIs, mutual funds. So between 1995-96 to now, in the last 10 years, we've actually seen a phenomenal growth of capital market, phenomenal growth of market intermediaries, and a host of things happening around us. And going forward, you can only see things happening more and more as RBI, the Reserve Bank of India, actually loosens the capital control. Right now, what they're doing, in my opinion, is very good. They're creating a lot of discipline in the market. There's a process which is happening. They're gradually opening it up, not in a very hurried manner. But 5 years down the line, you will see our markets fully integrated with the rest of the world, and thereby you will see many, many more opportunities emerging. As far as asset management industry is concerned, again, let me repeat that compared to what we see in the US, we are certainly a much smaller industry. In the US, it's about 5 times of the banking deposit assets, whereas in India is 1/20th of the banking assets. So you can see the difference, right? Because it has not touched the minds and heart of most of the retail investors. I like to pause here, very frankly, just to give you some warm-up session as to where I'm coming from, what the opportunities are, and maybe allow all of you to ask questions, and then I can possibly, at a later point, share with you some general experiences about the work, about the opportunities that you've got, and what you should be looking at, what you should be prepared. I just want to pause for a while. Somebody just take up the. Prashant, you want to ask the question? First question.
You've written a paper on the indexation industry. What kind of mutual fund would you prefer? Index fund or activity management?
Okay, I'll take this question later. This is a little too focused, not that I can't answer, I can certainly answer it. But we'll take some other questions, it will come back to this question. Any other question? Yeah.
When do you think that Indian markets would become efficient? Because as and when it happens, it makes the task of any of the AMCs much more difficult.
When you say efficient, what does it mean?
I mean, looking for higher underpriced stock or overpriced stock becomes much more difficult.
Okay, if you are referring to efficiency as in lot more disclosure, as in a few handful of people do not have access to that data, and it's much more public in nature. If you ask me very frankly, maybe 6 to 7 years back, I don't remember the exact date, when the regulations actually forced all the companies to come up with quarterly results. I think that was a landmark decision where today you see most of the corporates actually coming with quarterly results in the segment-wise data. That is one. Number two is, again I'm repeating, I think Infosys of the world have actually truly changed the complexion of this world. What is to happen, to be very frank, is before this first-time entrepreneurs like Mr. Murthy and others really came to this being and actually created wealth for the shareholders, including his own driver. Most of the entrepreneurs were in the ex, I'm not being political, but the ex-Congress Raj, where it was all licensing Raj, right? And builders of the world could actually walk in because they had the license with them, right? And they would get the financing, they would get everything. And those are the days when promoters mistakenly thought that as long as I can create wealth for myself or my own promoter group, that's about it. Probably there was very little care for the minority shareholders. Right? And the disclosures were very, very sketchy. There was a lot of insider information available. There was speculation going on, and there's so-called operators in the market, operating in the market. But believe me, in the last 6-7 years, again, thanks to corporate governance improving, and why corporate governance improves, let me tell you this. If you, for instance, invest in a company as an individual, right, you have so little say, you have got 100 shares in the company. Let's say UTI invests in that company, he's an institution, and he might or might not have a vote participation, but he can question, look, why did you do this and why did you do that, right? And then expand it to more number of players. Beyond UTI, let's say the 5 mutual funds invest in the same company, 20 FIIs invest in that same company, few private equity funds invest in the same company. Imagine the kind of questioning all these guys as a group will actually keep asking the main promoter. And that's what really typically happened. When the FIIs came in, while on the one hand they brought money, and that made the sponsor group very happy that I'm getting so much of excess capital. But they didn't come free, because they started questioning. They started questioning everything about your operations, about your risk control measures, and that's how the market started developing. But in the process, what happened that out of say 20 players, there are 5 players who are ready to open up, be transparent, be absolutely clear on what they are doing, and were able to take care of the minority shareholder. Their market capitalization went up, which we saw in Infosys, for instance. So the market capitalization goes up because of earnings and the price earning ratio. Right? So the earnings may be same for 2 companies, but the price earning ratio is a function of what the market perceives the company would look like 5 years from now, 10 years from now. So the market capitalization is what one should look at, not market price. Right? Today the market capitalization for ICICI Bank, interestingly, is higher than SBI. And people in the street, not people like the old people like me and Mr. Rangrajan, believe ICICI is much smaller bank than SBI, much smaller. And then SBI ran this beautiful ad campaign, and people in SBI thought as to why they are doing it. Of course, we are the largest, But I'm sure in this room, most of you probably don't know that SBI is much, much bigger than ICICI Bank is. But ICICI Bank market cap is bigger than SBI, surprisingly. With 600 branches as opposed to SBI has maybe 15,000 branches. But that's what the Wall Street does to the company. Because Wall Street allows that market cap, and that's based on P ratios. Now, where does the P ratio come in? P ratio is not only a function of where the economy is going, it's also a function of the corporate governance. It's a function of what the market perceives that company will continue to do year after year. So this issue which you touched upon is very valid. It's all about corporate governance. When I go to Japan and get money for Indian funds, this is what I tell them, that if you look at emerging market, by all studies, India emerges as #1 in terms of corporate governance. Now, I wouldn't have said this to those investors 10 years back, but today confidently I can say that. And believe me, again I'm saying, because I'm a great fan of Mr. Narayanamurthy, he is not only created wealth for investors, he has completely changed the landscape of this country. I think, he should be awarded with all kinds of awards from this country for having changed the complexion of the industry. So, coming back to the market efficiency, very frank, I think we are getting there. I don't think we have reached the same scale as US or other developed markets, but we are getting there. And it is all thanks to the fact that we have very smart, very savvy investors in the name of FIIs and mutual funds who are questioning the promoters. And if the promoter has this manufacturing tractors, there's one promoter, there's another manufacturing, same tractors. But I don't want to name the company. And then you find the stock price of this one is maybe 10 times of this. Why? You will question why. It's just because of that this company does not believe in transparent, taking care of minority shareholder, having the right kind of compliance and risk control, and this company believes in it. Its market cap goes up. So efficiency is improved in a lot if you ask me. And it has all happened because of large number of market participants. So as a phenomenon, if you have more participants who are questioning all the time, I think it will be better off.
So you just mentioned quarterly disclosures.
Yeah.
I read research somewhere saying that companies are so myopic because they're so focused on the next quarter's performance that they can make investments which have potentially don't add value in the long term. I mean, everything is just for the bottom line. There's a lot of investments which could otherwise in future be real value generators and drivers for the industry as well as the company itself. They don't tend to do that. Could you comment on that, sir? I mean, is that the case here?
Partly it is true, partly it's not true. Because if you're only focused on the next quarter or quarter after that, then what? Isn't it? After that, you used to say the company will die? No, not really. And today, the research that we do in the mutual fund industry is not just looking at next quarter. Because we will question the company as to why did you make this investment? First of all, let's say a company makes $100 million investment. Then we question, where do you want to fund that, finance that? He says, well, $80 million from internal accruals, $20 million from the market. And which market? Is it fixed income or equity? Is it fixed income? How will you service this? So everything is questioned. And then he tells us, well, this investment will mean that next 2 quarters will not look good for me. He confesses, it won't look good because my interest cost will go up, my capital investment cost will go up. Then a long-term investor, now there are different kinds of investors, right? There's a private equity investor who takes a 5-year call because his end customer is happy with the 5-year call. There's a mutual fund investor who maybe takes a 1 to 2 year call. And then there's an operator in the market who takes a 2-day call. Right? So there are different types of investors in the market. So this company will present his case to his investors and say, this is my plan. And the analyst from the various industry will assess that and say, well, we buy this, but we are not completely convinced about your long-term objective. Or you're getting into unrelated diversification. Or you're getting into something which you're not good at. Or you're acquiring a company which we don't believe you can run very well. And then this is happening. As long as thoughtfully done, as long as there is a merit in doing what he's doing, believe me, the investment community, he loves it. They say, great, we're investing. I'll give you an example of Myco, for instance, which is a German company, of course, but has a large Indian base. There, in the next 2 years, they made an announcement. They are so transparent that in the next 2 years, we will make 2,800 crores of investment in setting up these units. And you can rest assured for the next 2 quarters, our profitability will drop. People are aware of this, nothing hidden behind it, right? And then, from 3rd or 4th quarter, if the profit don't start increasing, then it will have impact on the share price. Coming back to your question that are people only focused on providing water? Very frankly, look at it this way. In today's capitalistic world, whether you like it or not, ultimately, everybody is putting money in a company because he wants to make money. There is no social objective. So the sponsor group, the main promoter, the management, is certainly interested in ensuring that the shareholder makes money. Now, I'm sure you're reading case studies. We used to also read 20 years back as to what is more important, employees or shareholders, or stakeholders, blah, blah, blah. I think all are important. If the share price goes up, the company is doing well, the employees are happy because they get higher bonuses. It becomes a better employer to attract talent. It becomes a better company to invest. It becomes a better company to raise more money. It becomes a better company to invest in larger assets. So I personally don't see why that's not important. That's very, very important. As a mutual fund company, I was in NDTV yesterday, and there's Ajit Dayal sitting next to me from long-term asset management. And I can just share this, I hope it's not recorded. But clearly, from the mutual fund company, ultimately my unit holder is not interested in what I speak in this room or how good human being I am. He doesn't care. He finally bothers about the return on his investment. Right? So that's important. Now you can manage the money differently. You can say, well, I'm taking a value approach, but you've got to wait with me for 1 to 2 years and then I'll give you a return. He said, I don't mind. After 2 years, don't tell me this didn't right, this will work right, this didn't work right, wrong. Similarly with the company, ultimately the shareholder has to make money. Right? So quarterly disclosure, what it does is to put a lot more discipline. Yes, you're right, there's some companies who might try to fudge their accounts a little bit. We can do it once or twice and then we get absolutely transparent. So the market, as Mr. Das we were discussing in the morning today, market is very intelligent. If something is happening in the stock market, you can rest assured that the market knows more. When I say market, it is much bigger participant list out there. So I don't think quarter results per se is bad. But yes, people do get carried away, and for them everything hinges on share price, nothing beyond that. Which in the long run, for some people, may not be right. But overall, if your objective is to provide good return to your shareholders, I think that's the right thing to do.
Sir, what hinders the growth of a such a technology? I mean, that's demand is there. There is suppose need for it. What hinders the growth of it?
Okay, the debt market, say 7 to 8 years back, was predominantly government securities market. There was hardly any market for the corporate bonds, except there was primary market placements. You understand what is primary market? So people used to just raise issues through private placement of non-convertible debentures or convertible debentures. That's about it. There's no market at all. There's no liquidity. People will just buy and hold to maturity. It's only in the last 5-6 years we have seen the corporate bond market, especially in the AAA segment, has certainly come up. Otherwise, mutual fund industry players like ours couldn't have survived. And I think one of the reasons why it has become so active is because of 30 mutual fund companies that are trading with each other. So you develop a market in the financial services where you have more players. When you have one single UTI, you don't create a market. So if we have more FIIs, more mutual funds traded in the market, equity market is much more liquid, much more vibrant than the fixed income market. The fixed income market players are still limited as opposed to the equity market. Fixed income market was always dominated by the bank. Even today, 90% of the government securities assets are lying with banks. But the government securities market, while it's very liquid, highly tradable, the corporate bond market is yet to. So if your question is what really hinders? What hinders is, one is lack of too many players, and number two is we have always played the yield curve game, the interest rate. People take a view on interest rates. As almost these days, people take a view on the tenor, 3 years, 5 years, and they play on the yield curve all the time. One, our economy is still closed. RBI does not allow beyond $2 billion of foreign money to come into the fixed income market. They have their own reasons to do that. If you look at any other market, it's absolutely seamless. So today, assuming that the market was opened up, and apart from the 30 mutual fund companies in India and UPI and the banks, we had a host of other foreign banks participating in the Indian market. And as you know, there are junk bond market, there are AA market, triple B markets, which doesn't exist in India. They are all focused on the AAA and AA plus. If that were to happen, you will see so much of money coming to this country, and we'll have liquidity in the market. I think it's lack of players, the fact that we are still a protected economy, we have not opened up because of capital controls, and the fact that traditionally, as I mentioned to you some time back, because of certain reasons, the default ratio was very high. Only a handful of companies really survived that very high interest rate regime. Somebody is from credit rating, Mr.Sandeep Dasgupta GIM mentioning. If you look at the last 5 to 6 years, the credit upgrade have been much superior than what it used to be earlier. In other words, we now have large number of mid-cap and small-cap companies which are fundamentally very strong, which was not the case before. So people were very apprehensive of buying into a AA paper or a single A paper. But today it's not so. In fact, we ourselves launched a fund which was rated AA for the first time in the country. And we took this bold decision because if the mid-cap stocks can do well, why not mid-cap fixed income market can do well? So it is happening, but it's happening very slowly as there is confidence emerging that the small and mid-cap sector is also fundamentally very strong. With the economic swinging at 9.5%, hopefully these companies also do well. And the spread between a AA and AAA is still about 50 to 75 basis points. Between a single A and AAA could be about 125 basis points. So there is merit in getting to that market, but I think lack of players, lack of confidence for some time, lack of liquidity is what is in the market.
So market crash from 12,000 to 8,000. Numerous reasons were propounded by the researchers. One was that Fed rate is increasing, commodity prices decreasing, the current account deficit of America, so many things. First question is how the Fed rate really impacts the Sensex and where it is moving. Second thing, when the FIIs were withdrawing money from India, the mutual fund industry, they were buying and they shown some confidence in the Sensex. What was the reason?
Okay. His question is about the fall that we saw this month of May, right? what really happened, and certainly market has again evolved back to the same levels. Maybe yesterday it was higher than that. See, very frankly, always remember one thing, that who is an FII? An FII is not an individual, right? FII is an institution which again is like a mutual fund, which has many large investors. And those investors are institutional investors, retail investors, private equity investors. Now, if the end customer, end investor decides that I want to pull out of emerging market because I feel a little uneasy, the FII will have no choice but to put a redemption request. So FII is also driven to a great extent by what the end customer is doing, number one. Number two, the second consideration he has is assuming that an end customer does not redeem and he has the assets, then his choice between India versus rest. If India is looking very expensive, he will have no qualms of pulling out of India, going to some other markets. Right? The third reason, so one is the end customer, the propensity to take risk in emerging market, which determines his actions. Number two, his decision to allocate his assets between 5 different emerging markets. If India looks expensive, he goes to Korea. If Korea looks expensive, he goes to Japan. Money is fungible. Number three reason is what you mentioned, the Fed rate. How does that really determine? What happens is, always remember that US is still the big brother, right? And if you look at all emerging markets, today India is sitting on about $165 billion foreign exchange reserves. China is sitting on some $550 billion. Singapore is sitting on $250 billion. Where is this money being invested? 95% of this money is invested in US treasuries, right? Why is it that, and that's been questioned again and again as to why you want to just park it at 4.5%, 5% trading. So, but that's how the institutional investors really behave. They don't want to take risk, and they want to stay aligned to US Treasury, US dollar. Now, when the Fed rate goes up, quite clearly, when the risk-free, I would say risk-free dollar-denominated Treasury rate goes up, there is again a propensity of institutional investors to move into those areas. So the pension funds, always remember, the pension funds, which are the biggest investors in US, they tend to take a very low risk investment ideas. They won't get to emerging market just for that. Even if they get in, they might be 1% of the total assets. A large part of the money is still in blue chip stocks or US Treasury or equivalent. Now, if the US interest rate goes up by 50 basis points, it's a huge amount of money for them, 50 basis points. So there's a tendency for them to pull out of some markets and get into US Treasury. Right? Now, on the other hand, somebody can challenge that, well, if the US dollar is about to depreciate, which has been the view for the last 2-3 years, then net to net you are losing out. For a Japanese investor to get into US Treasury, where Treasury might be giving higher coupon, but the dollar is depreciating against yen. So net to net we are not better off. So he would then put into maybe euro. So currency plays a role, interest rate plays a role. So there are many factors, very frankly. So what happened in the month of May, frankly speaking, is good that nobody could assign one reason. There was no one reason. Why? Because there are a host of FIIs today investing in this country. You can't even imagine the number of players who are investing in this country. We have Japanese investors. Within Japan, we have institutional investors, retail investors, we have investors from Middle East coming in, investors from US, Europe, and all kinds. When I say all kinds, there are private equity players, there are hedge funds, there are long-only funds, there are mutual funds. So, why a particular type of investor takes certain decision, it could be guided by many reasons. There is not one single reason why it happened in the month of May. Now, if it were one reason, the market wouldn't have rewarded so quickly. Because one group of investors did that, and suddenly the hedge funds is basically it was led by hedge funds, to be very frank. Because the hedge funds, as you know, borrow and invest. Hedge funds by nature borrow. They will borrow in US dollar, invest in yen, invest in emerging market. Suddenly the interest rate goes up in US, their borrowing cost goes up. And so they have to square up. If they have to square up, they will mercilessly, ruthlessly, they would redeem all their funds in the emerging market and pay back that money. And again the US interest rate comes down, again they will borrow. So you got to be prepared for this volatility. So when the hedge funds moved up, there was a panic in the market. And panic leads to panic, right? Retail investors said, oh God, this is over, I'm now dying. So he just puts redemption in order. That leads to another round of redemption. But the fundamentals of the company or the economy were so good that finally it came back, because most of the long-only funds realized that it was a mistake to be valuing this market at 13 times. So it should be valued at 16 times or 4 times. So there are a host of factors.
I spent my summers in investment managers and I found that about 2% of retail investors' savings only goes into mutual funds. And to say that's the right figure. And also, you mentioned about the FIIs and how they impact the market. I was also told that in days to come, their impact on the market is going to be much less, and mutual funds will come into greater prominence. I mean, so evidently, we're in an industry with a lot of potential, at least as far as the mutual fund industry is concerned. What do we do to attract more savings from investors, and your comments on that?
Okay. It is indeed true that if you look at the total pie, household savings, the word is household savings, less than 2% till recently, as per RBI data, was invested into mutual funds. Mutual funds, including bonds, stocks, and everything put together. 45% was invested in bank deposits. Right? About 32% was invested in life insurance, mainly LIC and other insurance companies. About another 30-odd% was in small savings schemes like your PPFs or Kisan Vikas Patras of the world. Right? In other words, if you look at any average household saving in this country, very small percentage is getting into capital markets. Very unfortunate, because of traditionally and historically large interest rates regime that we have always experienced. A person sitting in Goa, for instance, for your information, Goa is probably one of the largest market for bank deposits. Largest market. Banks are very happy in this market. So everybody puts money in bank deposits. And in this market, you hardly see mutual fund investments. Because that has been the traditional and maybe culturally developed. In a market like Ahmedabad, you won't see that. Ahmedabadis will always buy capital market products and try out different things. They're more prepared to lose money. In Goa, that won't happen. If you go to Calcutta, you have large amount of fixed deposits and even company deposits, but not in mutual fund. Now, that's true, absolutely. Now, if you look at US market, that number is as high as 35% or 40%. Okay? So how did this happen? This happened and will happen in this country, I'm sure about that. Is that, as I mentioned, always remember, in any financial market, it is the large institutional savvy customer who comes in first, because he is much more informed. He comes into the market much earlier. The retail customer follows him because he or she doesn't know the market, and he just follows the big guy. And the big guy also leaves much quicker, leaving this guy lurch, and he loses more money. But that's how it is. That's how the markets are across the world. Believe me, it's not only India. So what happened in the tech boom is the retail customer walked in the year 2000 March when market was at its peak. And by that time, some of the, not all, some of the institutional players had already gone out and selling all the stocks to the poor retail guy. And he got stuck with that for the next 5 years. So in this market, the mutual fund market also, if you look at the total mutual fund industry assets today, 65%, which used to be 75% till recently, 65% of our assets is from institutional investors in the form of cash fund, money market fund, short-term fund. Only 35% is from retail investors. And that 35% has happened in the last 3 years. Why? Because equity has done very well. As you know, equity is one product which is primarily engaged by the retail customer. In the mutual fund industry, nobody really buys fixed income, at least the retail customer, except till 96, 98 when the interest rates were going down. So it's predominantly the retail customers participating in the retail market. But that amount is so small compared to the total pie of household saving that there is a long way for us to go. And coming back to your question, what would really initiate this 2% going up to say 5%? I think it's for players like us to really act on it, have more education, more awareness about mutual funds, expanding into a large number of geographical sales offices. Because sitting in Goa, a person hardly comes to know about mutual fund till we guys actually go and make presentations. It is expensive. Client acquisition in the retail segment is expensive, unlike retail banking. For retail banking, the cost of running that book is much lower as opposed to asset management. Our margins are much lower. So initially, all the industry have started with 5 top cities. going down to 10 cities, now going down to 15 cities. And clearly, when I go around, I find the awareness is much higher today. SIPs, Mr. Nagarajan was mentioning, today is indeed true. There are about 100,000 SIPs. You understand SIPs, systematic investment plan. It's about 100,000, which is very encouraging, because then you see 100,000 customers. Every month there is a little investment being made. So it's happening, believe me, and to reach those levels of 35%, in my opinion, will take quite some time. Even if I reach 5% or 6% in the next 18 to 24 months, I would consider ourselves very lucky.
Sir, last time we did the news about players like private company, HDFC and Kotak entering the capital investment mutual fund schemes in which the investment of the investor is guaranteed. Now, as an investor, from the investor point of view, any investor would like his investment to be guaranteed from the side of the mutual fund companies. Will they be able to keep up to this expectation?
Okay, what's your name?
Sriram.
Sriram. Sriram is asking a question about not capital investment, not capital guaranteed or capital protection funds, right? Now, abroad, especially in Asian market, we have had huge success for the capital protected funds or capital guaranteed funds. Now, you wonder what is this difference between capital protection versus capital guarantee? A capital guarantee, as the name suggests, is explicit guarantee, that you are actually guaranteeing, and there is a cost attached to this guarantee. And normally, this guarantee is provided by a large bank or a financial institution, or if the AMC is hugely capitalized. For instance, if an AMC is capitalized at $5 million and is trying to guarantee a fund which is like $50 million, it doesn't make sense, right? So you would possibly not accept the guarantee of the asset management company, you accept the guarantee of a bank. Now, bank has to be a large bank like SBI or ICICI Bank, or if you're talking about cross-border transactions, then you would possibly expect the guarantee of the parent bank, like the Deutsche Bank AG of Germany. So the guarantee cost is very high. So what you are referring to is the guidelines today have allowed not capital guaranteed products, but capital protected products. What it means is not explicit guarantee, but you create a product in a manner that you can demonstrate that, well, these are the reasons why I believe that your capital is protected. For instance, just to give you an example, very simple example, you put 100 rupees into a mutual fund company, right? I take 85 rupees out of that and put it into a bond, and I buy that bond which matures at 100 rupees after 3 years or 4 years. Possible? Until there is a credit default, let's assume it offers a coupon of 8-9%. After 3 years, 85 becomes 100. So your capital protected. So you as an investor have given me 100 rupees. I take the 85 rupees, give Tata Steel bond, I buy Tata Steel bond, it matures after 3 years. I'll get back 100 rupees, I'll give it back to you after 3 years. Your capital protected. What do I do with this 50 rupees? Right? Then I play around with that 15 rupees. I can put this 15 rupees and buy options every month. I can take this 15 rupees, buy some blue chip stocks today. I can take this 15 rupees, buy some real estate funds today. I can take this 15 rupees, trade in the commodity market. I can do anything, right? As long as I tell you in advance, this is what I'm going to do with your money. You're going to be very, very clear. And you will say, alright, I don't have the expertise to play around in commodity market, real estate market, or whatever market. You guys are experts. Play around, I'm ready to take that risk. Even if I lose that entire 15 rupees, at least my 85 has become 100. So that is what capital protection. Now, as opposed to capital guaranteed scheme, where assuming that Tata Steel eventually would have defaulted, assuming, then you may not get 100 rupees. You may not get anything. You may get 95 rupees or 90 rupees after knocking at his door 20 times. Then what happens? Who loses? It's the customer who loses. Whereas in a capital guaranteed scheme, Deutsche Bank will come forward and say, look, I will pay for the balance and make sure you get 100 rupees. But to do that, the Deutsche Bank will be charging a lot of fees. The fees has to be borne by you. So there is this trade-off. Right? So capital guarantee schemes were popular, but because of this high cost and finally affecting the return of the investor, capital protection schemes have become a lot more popular. Sorry, somebody from there. Or somebody else, you have already answered. Yeah.
So how do you manage risk?
How do you manage risk? It's a good question. It's all about risk, very frankly. As you know, in financial services industry, there are essentially 3 groups of players. Right? One group is the traditional banker who takes money from the investor, okay, and
lends that money, which is the traditional banker as we all know. Right? There are borrowers, there are lenders. He takes money and is able to find customers who are ready to lend that money and gets the spread. And the spread is good enough to cover all his costs, especially the overhead cost and salary cost. He makes the net revenue. That's about it. That's traditional banking. There's another player who makes money in the financial services through transactions. What I call transaction, like a broker. What is broker making money in? Transaction, right? He doesn't take any call. He doesn't put in his own capital. He acts as an intermediary through the exchange or not through the exchange. Finds a buyer and a seller, and he becomes a transaction intermediary in between. And every time there's a transaction, he makes his commission. Whatever, 0.5%, 1%, 1.5%. So it's transaction. In transaction layer, probably the fiduciary responsibility doesn't come in because you're just providing systems and control so that you don't really get carried away, you don't put your own money, you're providing a platform. When it comes to banking, which I mentioned, what you require a lot of more than risk control is assessing projects and being able to evaluate the credit risk of companies and being able to lend to the right kind of company. If you make a mistake, then there will be default and your spread will come down. The end customer, in today's banking, fortunately, you are generally insured. You get back your money, but the bank might become weak or might run into losses, which happen to many banks. Then you come to mutual fund industry or FII. It's all about fund industry. The fund industry is a lot more fiduciary because it is not your money, right? You have not taken the money in your books. It is a fund, which as an asset manager, I just stay aside. I've been appointed by the trustee company to manage that assets. And I, as a responsible asset manager, is supposed to manage these assets well. And if you don't manage the assets well, as per regulation, the trustee company will actually kick you out and bring some other asset manager, as regulations allow. Then come back to the question of risk. So, mutual fund industry, very frankly, compliance and risk control is by far the most important issue. When I started my business in 2003 in Deutsche Bank, I started my business with 9 people, just 9. And people laughed at me and said, how do you manage mutual fund with 9 people? It's just that today's world, fortunately, we have got large number of service providers around you who are able to provide you custody, fund accounting, registrars, cash management. You don't need to do this in-house. You can all outsource. They're good service providers like Standard Chartered, JP Morgan, and Deutsche Bank. So when I started my career in asset management in 1996, we used to have all this in-house, and it used to be very high cost. Right? And when I say high cost, because you need to maintain large number of people, risk controls, compliance, a lot more checks and balances. But if you give it to specialists, it's all about specialist game today. Then you can actually outsource, and they are good at doing their job very well. You need to just monitor. Then we started our business, and I think somewhere in March, we had 13 people. Out of my 13 people, there were 2 persons in compliance and risk control. So you can imagine the importance given to that function. Out of 13, there were 2 persons in compliance and risk control. Today, I think that is the most important reason. The way we do risk control is very frankly, one is compliance monitoring, meaning there are some external checks and balances. For instance, SEBI, which is our regulator, has certain limitations in terms of what you can invest, what you can't. You cannot exceed more than 10% of your portfolio in any particular stock. You cannot exceed more than 15% in any particular industry group. There are many restrictions given. Apart from that, the main sponsor group, in this case, Deutsche Asset Management, we will have our own restrictions. That we will not go plus or minus 7% of the benchmark exposure or etc. We won't buy any stocks less than 100 crores market cap. Now, all these parameters are well defined, and then these parameters are told to the compliance, and they have to control them on a daily basis. So that is one of the most important risk controls, so that the fund manager doesn't get carried away. He certainly doesn't overnight decide that I like this company, let me go and buy. Number one. Number two is every company that we buy has to be it has to be a part of the research universe, what we call it. So you cannot just suddenly decide as a fund manager that so company made a presentation, I like the stock and buy. He cannot buy it. So they has to go through a process of investment committee. So that's another risk control committee. Number three is there are a host of other things which are happening currently in terms of KYC, in terms of suspicious trading. So we are constantly on the vigil as to what kind of investors are coming in. Because while you can put a lot of controls on investment, you can have to put control on the type of customers who are walking in. You cannot let the portfolio be exposed to few handful of customers who come in and go out, and that way impacts the performance of the fund. So there are lots of things which we do, and a lot of things is system driven. It's all technology which is put in place, the backbone. In the front end, what we do is, of course, on the dealing system, because the dealer's job, every dealer's job in a mutual fund company is extremely important, how he executes the deal. And that's where in the past we have had a lot of abuse of the industry, where the equity dealer, the fund manager, collusion with the broker has done many things which have led to a lot of scam, a lot of front running, etc. So all that our experience, because we are a part of a large global fund house, many things that happened in US would have never happened in India so far. So we have experience, and we try and curb all that by ensuring proper dealing system. For instance, in our company, we have the dealer entering, the fund manager looking into it. It has to be a 4I principle, as we call it, not just 2I, it has to be 4I. So it's always 4I. And in any German bank, it's always 4I. Any letter that we write, any order that we pass to a broker has to be certified by 2 persons at any point, not 1 person. That's where the controls come in. So there are a host of other things, I won't spend time on that. But clearly, that is probably the most important aspect in an asset management company, because you're managing somebody else's money.
As you already mentioned, FIIs are one of the main reasons that bring volatility to the equity markets.
Yeah.
Now, recently the finance minister had said that participatory notes, which invest into the in equity markets through the FIIs, are not don't need to be regulated. Now, what are your thoughts on that?
Very political question. Yeah, I will not really comment too much on that because this is controversial, very frankly, and this is right now in the jurisdiction of SEBI and Siddharth will know about that. All that I would say is that finally, what the spirit behind all this is that who is the end customer? What I call KYC, know your customer. And know your customer is a serious issue across the world today, thanks to the terrorism and money being funneled out of different countries. The participatory notes is nothing but challenging this particular aspect, that do I know the end customer or do I not know him? So as long as the KYC is properly met and it is just another what should I say, vehicle which is being used to invest, that's all right. So I guess that is what is being addressed right now. It's a question of KYC.
So one of the concerns for investors in investing in mutual funds was the operating expenses that were charged by the fund of the city. Now that this has been covered by the entry load itself, so how do you think this will have an impact in the investments in India?
Okay, first of all, let me correct you. This is not a new phenomenon. The load was always allowed. Operating expenses, very frankly, in the last 10 years that I have been in the industry, has not changed at all. It was always 2.5 going down to 1.75 as a increase. So, very frankly, there has been no change at all. On the load structure, we are allowed up to 6%. The market has decided to cap it at 2.25, 2.5 because the investor can't bear more than that. So I don't think you are very well informed, but I think that aspect has not changed at all. There is no change at all. No change.
So how do you explain quality to mutual funds, index funds, outperforming the index?
Outperforming the index. It's all about tracking error. You're right. Very frankly, index fund, as you know, is supposed to invest in the stocks exactly in the same allocation as the index is. Quite often, practically, it may be difficult. Either you didn't get the stock on that day, you couldn't execute it, something like that. But by and large, you're supposed to. That's why the tracking error should be as low as possible. And as long as it's programmed, as long as it's completely driven by technology, and there's hardly any manual intervention, I think tracking error will be very low. But yes, there have been instances of that, which probably is not right. Somebody else is asking a question.
So, considering retail channel like the most channel presently. Retail channel.
Yeah.
It's a broker in the IFA through which the product gets pushed. Like in markets like Ahmedabad or Mumbai, for them, considering say fertility or temperature have more or less same performing enemies. it's the brokerage structure which actually attracts the broker selling it to the end customers. So the end customers, Fidelity or Templeton or Trust or anything is more or less the same. So for having a growth, sustaining growth, what is the strategy?
Good question. Very specific to our industry, so I'm happy you're asking this question. Okay, in the industry, again, maybe it will benefit most of you in this room. Please understand that the distribution of financial products, I won't use the word mutual fund, just use the word broader term of financial products. That's a big industry, and there's some area which you guys might like to think of exploring yourself, because one, that's a very interesting industry, because you as a distributor are no longer called a dalal or a broker, you are called a financial advisor now, and you are truly a financial advisor, right? And you are now not selling just a fixed deposit or a pension, provident fund or an IPO. You are actually selling a host of products, right? And a good financial advisor is supposed to take care of the interest of the investor. I'll come to that, and offer him the right kind of asset allocation and right kind of product. Now, as you might be aware, maybe it's not new to you, there are essentially 5 types of distributors today. One is, of course, the banks. The bank as a category is by far the largest mobilizer of retail assets, financial assets today in the country. And that's not surprising, because they have supposedly trained manpower, better reach. A bank is a bank is a bank. All of us, by and large, tend to believe that I would rather put my money with a banker or talk to a banker. So that's more of a cultural issue. The second category are the investment bankers like Merrill Lynch or Morgan Stanley, who have their own indirect or direct channel, who are advising mainly the HNIs or the corporate investors. Then you have the so-called distributors, the plain money-led distributors like a Bajaj Capital or a Way2 Wealth or a RR. Now, this is an interesting phenomenon. When I use the word distributor, please understand, he is not a financial planner in a true sense. And he is more of a product pusher. You will see these guys all over the country, a small little office everywhere. And if you walk into his office, you will see there's no wall, there's all posters everywhere. Okay? And there are forms lying all around. What happens is, in that office, you will have huge traffic coming in. The customer walks in, and he's hardly expected to seek advice. At the most, he will just question on what is the brokerage you're giving, where should I put the application, some questions on the features, etc. That's about it. There's no financial planning, because the person sitting on the counter has no time for all that. He is a big churner. He is a typical distributor. Okay? And there are large number of those small outlets across the country. Then the fourth category is a truly independent financial advisor, as we call it, IFA. And he's supposedly a financial advisor, and by and large, my interaction with this group has been that although they were a very small number, today that's becoming a large number. And they are generally proprietary driven. There is a single person who is a chartered accountant, tax consultant, who has got into this activity. He has got about 150, 200, 300, 400 customers whom he genuinely provides advice. Okay? He's not driven too much by brokerages or what kind of gifts he's getting from the mutual fund company. I guess these are the 4 big categories, right? Not 5, 4. Out of these 4, the distributor community, if you ask me, is driven to a great extent by those promotions and marketing gimmicks and brokerages and incentives and all that, because he is providing the outlet and providing everything on the shelf, and you just pick it up. The person who walks in is driven to a great extent by his awareness about that fund house. Let's say he has seen a lot of Templeton or Fidelity in the advertisement, or he has read about them, saw the performance. He just walks in, seeks a few clarification, buys, and finally asks for some kickbacks. So that's where, unfortunately, in this country, the rebating or kickback is still prevalent, and despite all our efforts, probably it's not completely eradicated. And as and when more and more the 4th category emerges, the IFA channel, which is today much smaller total asset pool, if that group emerges, and that will happen when the ex-UTI agent or ex-LIC agent actually starts moving to the IFA segment and starts advising a lot more customers. That segment is very less driven by the brokerages and marketing. So there are different segments, and it all depends what kind of customer you are in. If you are a very well-informed customer and you are very interested in rebating, you go to the 3rd category. And if you're a customer who really genuinely seeks advice, you go to the fourth level.
So what role does a fresh MBA play in an asset management company?
Okay, let's come to now the serious talk. Right? Okay. No, interesting. Okay, let's talk about asset management industry. Right? In asset management industry, typically you have three groups. Okay? One group is the sales and marketing group. Another group is the investment management group. Another is the operation back office group. Now, within the operation back office group, we have a separate group called compliance. Generally, we hate to say the compliance reports to operation. That's not right. So, compliance is a different value structure. So, it's compliance, operations, back office, investment, and the sales and marketing. There are three large groups, right? Now, out of these three large groups, very frankly, a fresh MBA. When I say fresh MBA, let's assume that you're not fresh as a fresh. I mean, maybe you've had 1 or 2 years work experience, which looks like most of you've got, and a relevant market. Maybe you've done some research, work with some company or a bank or whatever, then did your MBA. In a large fund house, you can possibly look at an entry-level career as a research analyst. You can. But it's very limited. The reason being that most of the basic research currently is being done by the broking houses. So when you join a broking house, they have specialists in IT sector, specialists in financial services sector, specialists in pharmaceutical sector. Whereas an asset management company won't have those specialists. You will have an analyst which does take all this research inputs, talks to his fund manager and makes some assessment, and based on that the fund manager actually decides to buy. So the number of research analysts being hired in asset management company are still very limited. Maybe 1 or 2, and larger fund house maybe 2 or 3. But 2 or 3, the higher you go, they're looking for experienced people. So at the entry level, it's rather limited, very frankly. The other option is you join an asset management company in the sales and marketing area. Now, in the sales and marketing area, again, there are two kinds of salespersons being hired in an asset management company. One is the relationship manager, who actually manages the entire relationship of the distribution network that we talked about just now. And he's supposedly slightly experienced, maybe 2 to 3 years or 4 years, and then he goes up in life. But he or she also needs junior feet on street, as we call it. Okay. Then there is another group we hire for mobile sales support. Now that's not for the MBAs like you. It's mainly for the graduates who are running around all the time, knocking at the door for IFA or a distributor. But at the junior level, in a large fund house, there is requirement for a fresh MBA, and people are now moving around and trying to hire people who they can train. Even if you get trained for 1 year under a senior relationship manager, you can become quite proficient in managing the financial product, because it's all about knowledge. You got to know a lot about the mutual funds, the products, the various laws and regulations surrounding that. And always remember, when you are meeting a customer, who is your customer? Your customer is the end customer who is providing money to that company, or is the distributor. He or she is expecting you to know a lot. You cannot say, well, I'll come back to you. Then you lost the deal. So there's a tendency by asset managers to always hire people with a little bit of experience. But as the talent pool is only going down, more and more asset managers are more than happy to hire MBAs with a little bit of experience, maybe 1 or 2 years experience, and train them on the job for about 6 months to 1 year, and so that they are well equipped to handle the sales and marketing job. That's the second. On the operational side, not that we don't need, we certainly need bright MBAs coming and joining us, but we have seen that very limited desire from MBAs to join a back office operation, because they somehow feel that if I have to do back office, I would rather join an IT company. Why should I join an asset management company? Not realizing that the quality of job that you do in asset management company, because as I mentioned to somebody, we have outsourced large part of the little bit of menial kind of job to other service providers. What you do in asset management company is really quality job. You get into settlement, you get into, and for, again, I'm not being very biased, but maybe for the woman, it's a good job, because it requires a lot of thought process, a lot of analysis, handling all the service providers. If you have that urge to really sit down and work for the details, without getting too disturbed by, and you're not the front-end type, you're not the salesy type. If you're the sales type, you won't like that job. If you're the type who likes technology, wants to know a lot about risk control, compliance, operations, settlement, dealing with banking institutions, service providers like registrars, you enjoy that kind of job, that should be interesting. So that's another job that, in fact, I have also hired 2 or 3 girls, not fresh from the MBA institutes, but they are reasonably junior. Somebody passed a CA, was doing a CA, and was a training with her at the temporary, and we just absorbed her because she was not very good. I've seen that that's a job which you might think is not very fulfilling or enriching, not so hot, not so, well, I don't want to use that word. So you can still look at that option. Another the new areas emerging, which is the alternative assets like real estate and other stuff, but those are a little more advanced, and I don't think we will hire fresh MBAs for that. Any other related questions? Feel free. Yeah.
You look at the US market, as a fund manager, you have a range of stocks to choose from, 100,000, 5,000, 10,000. Both the depth and the breadth of the Indian market is so limited that once you end up becoming a big fund manager, how do you differentiate yourself from the other guy? Because you got the same stuff that he has. There really isn't much to choose from.
Okay, I can argue it differently. If you look at the US market today, there is a large amount of money going to index funds. The reason being that in terms of percentage, there is a small percentage of active managers who are beating the index funds. There are lots of them who are doing worse than an index fund. And again, because the markets are too efficient. I don't think it is true that we have lesser number of stocks to choose from. I think we definitely have more stocks than many countries, but most of the stocks below to a lower end are so illiquid that you hardly can buy them, and that's where the private equity players are coming in for the small cap or mid cap. But it's a process which has started a few years back, where we are now seeing participation in the mid cap segment. As far as the comparison between 2 fund houses is concerned as to what do they look like. Right now, if you look at, very frankly, there is huge difference. In fact, my bosses in Singapore get astounded that how come in the same period, there is one fund house which has given 23% return, another fund house has given 49% return. How come there is so much of difference? In the same market, you are not buying other markets. I think stock picking is still becoming quite important, and your ability to move across different sectors and different stocks and how quickly you do that, maintaining your performance is becoming still very important. I think as the market becomes more mature, our market like US, probably the spread between a very good fund manager and not so good fund manager will actually shrink. Today is very wide. If you look at any performance track record, you will find in the last 1 year or 2 years, a huge difference between I don't know name again, this fund house versus this fund house. And you will be surprised as to how come this guy did so badly and this guy did so well in the last 1 year in the same market. So the difference is very high. So in fact, it's the other way. I think US markets has become narrow, very narrow. So you can't pick one fund manager who's done exceedingly well and another fund manager done very bad. Until you get into private equity space. In private equity space, you can make astronomical return, not in the mutual fund.
So perhaps you could elaborate on how to plan the career in financial services.
Okay, see, in the financial services, as I mentioned in the beginning, you have now, let's say, the various groups. One is the banking group, you have the mutual funds, you have the insurance companies. You will very soon see the pension funds emerging. You will see, of course, you have the broking houses. Now, most of the big banks like ours or ICICI or SBI have everything as an offshoot. Like we have Deutsche Bank, which has a broking company, which has a asset management company, which has a retail banking now coming up, with the transaction banking, private wealth management. So you have different offshoots. And there are independent investment bankers, independent asset managers who have no affiliation to a bank. Right? So you have either a universal bank, as I mentioned, ICICI or SBI or Deutsche, who have ambition to get into everything. Right? So you are part of the main bank, but you have different outlets. And then you have independent insurance companies like Standard Life or New York Life, who have no other businesses but for insurance. Right? Then you have independent asset managers who have no other interest in this world but for asset management, like a Reliance or a Fidelity or a Capital. Right? Then you have non-banks, but who are as big as a bank, like a Merrill Lynch or a Morgan Stanley, who do not have a banking operation, but have everything except for banking. They have asset management, they have broking, they have investment banking, private equity, loan markets, all kinds of things except for banking. Right? So you have wide choice. Now, for you, for instance, if you look at any of this segment, you can have an opening in any of these places. Question is, as she asked me, as to will I, as a fresh MBA with a little bit of experience, will have a chance to get into everything? Possibly not. If you look at banking, for instance, let's assume a foreign bank like ours or a JP Morgan or Citibank. When you talk about the consumer banking, retail banking, that's where they had a large number of people and there is a lot more turnover in Washington which is happening. So that's where a fresh person obviously gets a much easier entry. But if you look at a little more advanced departments like global markets or structured finance or FX or derivatives, that's rather difficult for an inexperienced person. Now, you might say, look, I want to get into that department one day, and I will build myself for that. Then you are very focused. And then you have to sacrifice what I call money on day one, or the real cushy, the hot job that you got in your campus and you feel very good, your girlfriend is happy, your boyfriend is happy. Then you got to sacrifice that. You got to say, look, this is my goal. I want to get into the global market, capital market division or FX market division of the foreign bank. But I can't get in now, but I need to gain experience. So where do I gain experience? Then experience or learning has become more critical to you as opposed to getting the first day job. Okay? Other one is, but what I would advise all of you is that please do some research between now and December is when your placement happens as to what you want to do. When I left IIM Ahmedabad, just to share my experience, as you know, in our institute those days, the day you got a job, that's it. You can't apply for the next one, right? So I was in the final list of a company called Seat Tires. Imagine selling tires, me. Okay? But I would have been doing that if I got that job, maybe. Okay? And then suddenly ICICI Bank happened. I was very keen on ICICI, it's not bank, ICICI. And I was on the final waiting list, and I was very disappointed that I didn't get that job. And for my good luck, one of my colleagues, he decided not to join ICICI, he decided to join, I think, TCS those days. And there was a vacancy created, and Mr. Dasgupta got that job. And I said no to Seat Tires. And from selling tires, suddenly I was in financial services. So I think you want to be very, very clear what you want to do. And none of us, not none of us, most of us, unfortunately, especially people like me who have no work experience, we're absolutely unclear as to what we want to do. Right? We saw this beautiful company offering lots of money and we would have got into that. Maybe we wouldn't have enjoyed that and we would have moved back to some other departments, some other job. We would have lost a couple of years. And people have done that. They've gone into some industry, moved back. Like I was in investment banking, right? And today if I stayed with investment banking, maybe I would have been richer or whatever, but maybe I was not enjoying that as much. So I shifted back to asset management. I'm very happy. So it can happen later in your life or early part of your life. If you can spend more time talking to people like me and others in the industry as to what each job offers, what is the future prospects, does it match with your personality? It's very important. It should match with your personality, what you are good at, what you don't like or like. Then if you can make the decision early enough, it's much better. Very, very important. The first job of your career after your MBA is will actually shape up as to which way you're heading. And after 10 years, suddenly you realize, oh gosh, I didn't want to do this. For instance, again, my example, before my MBA, after engineering, I worked for a year in a computer firm called CMC Limited, which you know, right, as a software programmer. I was doing fine, but I told myself, I don't want to do this throughout my life. Just writing programs. You just can't do it. Even today, if you ask me anything beyond Excel and Word, I'm very poor. I'm not good at technology. So I realized that I'm not good at this. And while I do well because of my intelligence, but I don't enjoy it, I don't think I go up in life. So I decided I'd rather use computer as a tool than being with the computer all day long. Now that's an early decision one takes. So if you can take those decisions early enough, it's much better. That's my personal advice to all of you. Please take some time off and decide as to what industry you would like to get into first. There are many people, Prashant is telling me, about getting into IT. Nothing wrong. IT will continue to do well in this country because India, because of natural advantages of English speaking, young population, we all know that the demographics are so powerful in this country that IT will continue to do well. Now, you should not get into IT just because it's offering that 30% extra salary. You should get into IT because you should truly believe that you want to enjoy that work. And within IT, you say, look, I love programming, I enjoy it. There's another person who says, I'm very, very good at sales, I enjoy sales. Now, would you like to do sales in IT or would you like to do sales in manufacturing or FMCG or financial services? Every industry has sales. What is it that you enjoy? Right? I chose investment management, asset management because I enjoy intellectual simulation. I like to be with people who are intellectually good, knowledge driven, rather than just selling. There are people who don't like all that. I just want to sell. I just want to be there in the marketplace and sell. Nothing wrong, nothing right about it. You should ask yourself what is that you like. Otherwise, what happens is you lose at least 2 to 3 years of a productive career, and suddenly you realize that, well, now that I've shifted back, I actually lost 2 to 3 years. That's a lot of time, a lot of money down the track. So do that research first, because the first job is going to actually provide you that direction. The second job of yours will provide you the real experience. And the third job, maybe will be the longer one, hopefully, will actually make you succeed. And as I was telling Prashant, always remember, that's my experience, and everybody said that, you actually make serious money in your life after the age of 40, if you're in corporate world. Okay? Serious money. You don't make serious money before the age of 40. The reason being that by the time you're matured enough, you have a lot of wisdom, you assess your own strengths and weaknesses, you develop relationship. So before that, what is critical is how you shaped up your last 15 years or 10 to 12 years. How you shaped up and reached that position. That's very critical. So the first job is not as important as you guys think. First job is very important for you to step on to the right place where you want to get into. Now, if you didn't get into ICICI Bank and got into GIM Financial or Kotak Financial, all are the same as long as you are able to meet those objectives finally. And I want to get there eventually. And the first job is very critical from the learning perspective, very important. So in the financial services, I think I broadly touched upon everything. Insurance will provide you a lot of opportunities if you're a salesperson, salesy type, join an insurance company, join a retail bank. If you're the type who is very, very good at analysis, structuring, you should aim for investment banking career. If you're the type who enjoys stocks, right from I have a person who is now the CEO of another mutual fund company. Even in the MBA days, they used to talk about stocks. And there are people who are inherently interested in research and understanding stocks. You must aim for a broking company or a asset management company, because that's the core activity of any of these companies. So it all depends what you really want to do. Anything else?
One last question for
where does the CEO head? Where does the CEO go? I mean, getting out of a preschool, we all have our aspirations, etc. Once you reach the top of the game, I mean, what's next? How do you still maintain the